Hey everyone, welcome back to Corporate Decoder, the place where we unearth the hidden truths behind the endless stream of corporate filings. Get ready because today we're diving into First America Resources, Corporation's latest 10Q report, and let me tell you, there are more twists and turns than a pretzel factory. Before we jump in, if you love getting unfiltered insights directly from the source documents that shape our financial world, do us a favor and hit that subscribe button. And hey, we've got a thriving community over on Discord where you can chat with us and other savvy investors about these reports. So the link is in the description below, go check it out. Alright, first things first, this is a quarterly report, a 10Q from First America Resources Corporation. It covers the period ending the 30th of September 2025. Think of it as a mid-year checkup for the company's financial health. Scrollers of the 17th of November 2025. There were 87964,090 shares issued and outstanding of the registrant's common stock. Scroll now, a key piece of info right off the bat as of mid-November 2025. They had over 87 million shares of common stock out there. That is a pretty big number and it tells us who owns what and how much voting power each share has. Let's zero in on the big picture financials, starting with the balance sheet. This table shows us what the company owns, what it owes, and what is left for the owners at two different points in time, the 30th of September 2025 and the end of the previous year, the 31st of December 2024. Looking at total assets, they went from about $6.87 million at the end of 2024 to around $6.65 million by September 2025. That is a slight dip, not a massive one, but it is something we'll keep an eye on. This means the company has a little less in terms of what it owns. On the flip side, their total liabilities went down too, from just over $8.2 million to about $7.5 million. So they've managed to reduce what they owe, which is generally a good sign. Now, things get interesting when we look at total stockholders deficit. This is an accounting term that basically means the company owes more than it owns. So basically, the owners have a negative stake. This swung from a deficit of about $1.37 million at the end of 2024 to a deficit of around $868,000 by September 25. This is a significant improvement, showing they're moving in the right direction, closing that negative gap. Moving over to the income statement, which shows how much money the company made and spent over a period. Let's look at revenues for the 3 months ending the 30th of September 2025. Revenues were about $5.47 million, up from roughly $4.58 million in the same period in 2024. That is a nice jump in sales. Their cost of revenues, which is what it costs to produce or acquire the goods or services they sold, also went up from about $1.96 million to $2.53 million. This resulted in a gross profit for the quarter of about $2.94 million in 2025, compared to $2.62 million in 2024. So they're making more profit on their core sales. Now, let's talk about operating expenses. These are the costs of running the business beyond just the direct cost of the goods or services. For the 3 months ending the 30th of September 2025, these expenses were about $2.69 million, up from $2.22 million in the same period last year. A big chunk of that increase is in payroll, which jumped from $1.22 million to $1.36 million. Rent and lease expenses also rose by about $72,000. But what really stands out is the jump in professional fees, which skyrocketed from just $26,000 to $173,000 in that same 3-month period. The report mentions this is largely due to merger costs and related legal and audit fees, probably stemming from the Metec deal we'll talk about later. Because of these rising expenses, even though revenues were up, their income from operations for the quarter actually decreased, falling from about $405,000 in 2024 to around $248,000 in 2025. So while they're selling more, it is costing them more to do it, eating into their operating profit. Looking at the bigger 9-month picture, revenues climbed from $12.44 million in 2024 to $14.32 million in 2025, a 15% increase. That's solid growth. Cost of revenues also increased, leading to a gross profit of $7.69 million in 2025, up from $6.86 million in 2024. Operating expenses for the 9 months rose from $6.28 million to $7.44 million. Again, payroll and rent are up, but those professional fees saw a huge jump from $141,000 to $319,000, again attributed to those merger and acquisition related costs. As a result, income from operations for the first 9 months of 2025 dropped significantly to about $247,000 from $577,000 in the prior year. This trend of rising costs, especially professional fees, is a big factor here. Now, let's talk about other income and expenses. They had a pretty interesting item in the 9 months of 2025, an employee retention credit of around $346,000. That is a nice boost to their bottom line, showing up as other income. After all that, net income for the 9 months ended the 30th of September 2025 was about $501,000 compared to $510,000 in 2024. So despite the revenue growth, the increase in expenses, particularly those professional fees, kept their net income relatively flat for the combined 9-month period. On to cash flow, which is super important for any business to survive and grow. At the end of September 2025, they had about $400,000 in cash, down from $459,000 at the start of the year. For the 9 months of 2025, they generated about $129,000 from their core business operations. That's less than the $475,000 they generated in the same period in 2024. This shows that while they're making money, their operating activities are using up more cash than before. Investing activities like buying equipment used up very little cash, just $1,500 in 2025 compared to $74,000 in 2024. They are not investing heavily back into the business right now. Financing activities, which involve borrowing money or issuing stock, used a bit more cash in 2025, about $186,000, compared to a much smaller $34,000 in 2024. Now, for a really significant event mentioned in the notes, the METEC exchange agreement on the 16th of April 2025, First America Resources Corporation acquired 100% of METEC Recycling. In this deal, First America Resources issued 80 million shares of its own stock to the METEC shareholders. This is an accounting maneuver called a reverse acquisition. It means METEC is treated as the company that bought First America Resources for accounting purposes, even though legally First America Resources bought METEC. This affects how their past financial results are presented. And what is METEC? It is a company focused on electronic waste management and asset disposition. They handle recycling of electronics, secure data destruction, and managing equipment. They seem to be focused on sustainability and recovering materials responsibly. Let's look at concentrations. This is crucial because it tells us if the company is too reliant on just a few customers or suppliers. For revenues in 2025, customer A accounted for 13% of revenues. Customer B also 13%. Customer C was less than 1%. This tells us that their customer base is somewhat spread out, which is good. Looking at accounts payable, vendor A was responsible for 35% of their payables in 2025, down from a much higher 69% in 2024. This shows they're diversifying their suppliers, which reduces risk. Scroll at the 30th of September 2025 and the 31st of December 2024, outstanding notes payable due to First American Management Group Corp., the company's largest shareholder, total $556,000 respectively. So scroll-related party transactions are always important to scrutinize. At the 30th of September 2025, they owed $556,000 in notes payable to First American Management Group Corp., who is their largest shareholder. Scroll at the 30th of September 2025 and the 31st of December 2024. Outstanding notes payable due to Famback. The company's second largest shareholder totaled $657,000 and $157,000. Respectively, scroll. They also owed FAMAC, their second largest shareholder, $657,000 in notes, payable as of September 2025. Scroll FAMC, his customer A and vendor are note 6. At the 30th of September 2025 and the 31st of December 2024, accounts payable due to FAMC totaled $1167000 and $2303000 respectively, and accounts receivable due from FAMC totaled $220,000 and $466,000 respectively. Scroll, and here is a real key point. FAMC is also customer A and vendor A. This means a major shareholder is also a significant customer and supplier. They owed FAMC over $1.1 million in accounts payable, and FAMC owed them $220,000 in accounts receivable. This close financial entanglement with major shareholders can sometimes create conflicts of interest or unusual business arrangements, so it is definitely something to watch. Now, management's discussion and analysis. This is where the company explains its own financial performance. They state that revenues increased by 19% in the 3-month period and 15% for the 9-month period, driven by continued growth. They expect revenues to keep going up. They also mentioned that operating expenses are expected to increase with revenues as they expand. This aligns with what we saw, with rising costs, especially professional fees related to the acquisition. Regarding liquidity and capital resources, they had around $400,000 in cash at the end of September 2025. Cash generated from operations was lower in 2025 compared to 2024. They acknowledged they might need to raise more debt or equity capital to fund their operations, which is a standard disclosure for companies growing or facing cash flow challenges. Finally, on controls and procedures, the principal executive and financial officers have evaluated their effectiveness and concluded they are effective. This means they believe their systems are in place to ensure financial information is reported accurately and on time. So, what is the story here with First America Resources Corporation? On the positive side, they've managed to significantly reduce their overall deficit, meaning their financial position is improving. They've also seen revenue growth, which is always a good sign, and the acquisition of Metec seems to be adding to that revenue stream. Diversifying their vendor base is also a smart move. However, there are definitely areas for caution. The sharp increase in professional fees driven by acquisition costs is eating into their operating income. While the acquisition of Metec is a strategic move, it's crucial that those costs don't spiral out of control and that the acquired business truly adds value beyond the immediate revenue boost. The heavy reliance on transactions with major shareholders like FAMC also raises a flag. While not inherently bad, it requires extra transparency and careful management to ensure fair dealing for all shareholders. Looking ahead, the key will be managing those operating expenses, especially professional fees, and successfully integrating Metec to realize its full potential. If they can control costs while continuing revenue growth, they have a good shot at further improving their financial health. But if those costs continue to climb without proportionally higher revenue or profit, it could put continued pressure on their operations. Alright? That is our deep dive into First America Resources Corporation's latest 10Q. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more corporate decoding every week. Don't forget to check out the Discord community in the description. It's a great place to keep the conversation going. Thanks for watching, and see you in the next video.